Hi, and welcome to our mini conference. Today we have Fred Thiel from Marathon. Fred, would you mind introducing yourself to our viewers?
Sure. I'm Fred Thiel. I'm Chairman and CEO of Marathon Digital Holdings.
Great, wonderful. I think the topic on everyone's mind right now is the halving. You went into some excellent color on your most recent conference call regarding your thoughts about what might happen to global hash. I think probably a few months ago, the street was expecting maybe a 25% decrease in hash. What we're hearing from managements now is more like a 10 to 15%. What are your thoughts there? And what do you think about, call it Bitcoin's fundamental setup going into the halving?
Well, I think many of us had expected Bitcoin pricing to not have appreciated as much or be as sticky as it is around this prior all-time high number,
Yeah,
high
myself included.
60,000 number. Looking at things, the popularity of the ETFs really have pulled forward the cycle, I think. So what we're seeing now is kind of the demand we would have seen typically 3, 4, 5 months post halving. That being said, there's no telling what the behavioral pattern going forward is going to be because the dynamics today are the market is very illiquid. There's not a lot of liquidity in the spot Bitcoin market. These ETFs are buying a lot OTC. Um, Also, institutions haven't really started buying these ETFs. This is mostly hedge funds, people who were playing the equity side of the market before with minor stocks. You've seen some cycling out of minor stocks and into the ETFs and retail buyers. And as we talk to institutional investors, they're evaluating the ETFs, but they haven't committed. And when that commitment happens, you'll see more movement on price because it'll be more demand shock. The halving, which will happen here in just a few weeks in April, the supply shock there, a decrease of 450 Bitcoin per day that are issued, likely will have some impact, though it's a little hard to tell, again, because the illiquidity in the marketplace. Uh, Market is really, supply is very much driven by where price is. As price pushes around this 70,000 mark and beyond, you're going to see older supply that's been locked up coming back to market, is our belief, at least. So the longer term for this year, we think the impact is going to be Bitcoin price will likely hover around this range. There's a bit of resistance at the 71, 72 range that it would have to pop through with some good momentum, I think, to stay up beyond. And I think we'd see a lot of profit taking as any step between here and 100,000. And once we've cycled through that profit taking, you could then see another up leg, definitely next year. But for miners, it's really been kind of a Goldilocks event in the sense when you think about it, in 2023, we actually went through a halving event. The global hash rate grew by 100% in 2023. Bitcoin price moved up more than that. We're continuing to see strong Bitcoin price appreciation. And I think what will happen here is, if the average global kind of marginal cost to mine across the industry is, let's say it was 20,000 in Q1 before the halving, post halving, the global marginal cost to mine would notionally go to 40,000 just to keep the math simple. With Bitcoin at 70,000, we're still very profitable as an industry. It really comes down to this, who's going to continue to add hash rate and where global hash rate's going to go. And there's an incentive for miners to keep adding hash rate as long as it's profitable. So if Bitcoin price doesn't make a major move downwards, it's more likely than not that you'll see global hash rate actually grow versus drop at the halving. I think there's a lot of machines that have been ordered by the big miners, ourselves included, that are going to be coming online over the next 6 months. And that will negate most probably any correction from older machines running in locations which might be borderline profitable. I think every 10K drop in the price of Bitcoin, though, you'll definitely see some negative impact on global hash rate as that comes off.
Yeah, so there's kind of a nice balancing act there, right? As you see coin decline, you see that hash rate come back and call it your yields normalize or should over time. You mentioned something very interesting there, not to get too far off on a tangent, but you mentioned some rotation we had seen recently out of Bitcoin miners and into the ETFs. I think that's right. But I think also, and I'd be interested on your thoughts here, I think the miners offer a lot of leverage to investors who are looking to get coin at cost, right? I guess what are your thoughts there about the advantages of investing in a miner versus just the straight coin?
Well, I think the example I always use is Warren Buffett. You know, he doesn't buy gold; he buys gold miners because he wants to have the benefit of, in an up market, the margin that's generated by the producer of the commodity increases greatly, and the equity is typically underpriced for that additional margin. And so, if you invest early in the cycle, you get to catch it very nicely. I think we've seen. There was a belief amongst certain groups, I think, that you invested in miners because you couldn't get exposure to spot Bitcoin otherwise, if you were especially a hedge fund or some other fund that couldn't hold spot. And so the miners gave you exposure, ETFs came out, Bitcoin started running, and there's an arbitrage play, and it's kind of a three-way arbitrage play. Not to get too technical, but the ETF settled T+1, which means they don't actually buy or sell Bitcoin until the day after somebody has gone in and asked to buy shares or sell shares of the ETF. So there are a number of investors who front run that trade. And especially you'll notice this on weekends, because the transactions the ETFs do on Friday aren't actually settled until Monday. And so you have all weekend to manipulate the price of Bitcoin, if you would, and then take advantage of it. So you're seeing a carry trade essentially going on between the ETFs and spot Bitcoin and the miners. And so people are kind of playing this around. And I think you've even seen some of that with MicroStrategy stock as well, where these are three different flavors of things you can do. You can hold spot Bitcoin and it moves at its 1 or 2%. But if you look at this week, the miners have been moving with that increased beta that they typically have to very de minimis moves in the price of Bitcoin. I mean, yesterday there was a big move in certain miners, ourselves included, and yet Bitcoin didn't really move a whole lot. So you're continuing to see this kind of arbitrage play going on, I think, between the three kind of buckets. Over time, I think that will settle out somewhat, but the miners still are a much better leverage play. Longer term, you're going to continue to see miners, especially miners that hold large Bitcoin positions like ourselves. You'll see definitely a beta to the price of Bitcoin, especially in the up market, and you also see it in the down market. The prices decline faster than Bitcoin in a down market, but they accelerate faster than Bitcoin in an up market. And I think we're going to go back to more normal patterns here as we get into the later stages of Q2 and into Q3.
Yeah, very good. One thing we've been asking the managements about is the current mining pool, right? I guess what percentage do you think of the current mining pool is from publicly traded miners? And what percentage is from, call it, nation states who are looking to do this for, perhaps, to get exposure to coin, perhaps for other reasons? Are you seeing an uptick in that, call it, like, sovereign state mining?
Absolutely. So US publicly traded miners used to represent about 28% of global hash rate. I think it's now down to 22%. So, and the publicly traded miners haven't been slowing their expansion plans. If anything, they're accelerating. So that only leaves non-public and nation state actors to blame kind of for that growth. You've seen Russia as a country, as a location for mining, develop a very strong number 2 position. They've now supplanted China in that number 2 position. China still has about 20% attributable hash rate coming from Chinese miners via China. Are they obfuscated as HPC AI vendors for the Chinese government? I don't know, but at least from source addresses of the IP addresses of miners, that seems to be the analysis that most of the companies that look at this produce. We have seen a lot of interest from sovereigns interested in mining. And it's interesting that it's not because they're looking at the profitability of mining as a way to generate revenues for the country. Because if you think about it, getting into the mining business today, there are only 1 million Bitcoin left to be produced for a nation state. 1 million Bitcoin, while if they could get all of them, it would be significant. But realistically speaking, if a nation state were to try and capture 5% of the Bitcoin global hash rate, similar to what Marathon has, that's a lot of capital and time that has to go to do that. And you wouldn't do that just to get 5% of a million Bitcoin. What you would do, however, is you would want to be mining such that any Bitcoin you hold that you acquire in the open market, you will always have the freedom to transact. And this is a key thing. If Europe and the United States together were to decide to weaponize essentially Bitcoin and say, you know what, you have to be OFAC compliant in all your trades, they would go to the pools in the US, they would go to the miners in the US and say, you can only process transactions that come from OFAC compliant wallets. And you have to censor transactions. Well, if a nation state is sitting with, $500 million in Bitcoin, if they are mining, they at least have the ability to transact Bitcoin still, no matter what any other government is doing. And so there's a vested interest in nation states that have access to inexpensive energy to partner with miners and have notional control of mining capacity so that they can then feel comfortable in holding an allocation in Bitcoin as part of their asset. So I think they are the biggest, by far the biggest investors in Bitcoin right now, infrastructure that we're seeing. The Middle East is quite large in this aspect. The Kingdom of Bhutan, for example, is adding 200 megawatts, which is somewhere around 15 exahash almost of capacity, which in terms of the global hash rate is basically somewhere around 2%. So that's significant for a very small nation like Bhutan. So I think you're going to continue to see this go on.
Yeah, it's a very interesting trend. It'll be great to see how it unfolds in 24 and 25. And speaking of looking forward, big picture, where do you see the industry going in the next, call it 3 to 5 years? You've been taking a move toward vertical integration. Do you think that that's a trend that's going to continue to gain momentum and call it 24, 25, 26 on a broader sense?
Well, we're always the kind of the anti-trend because our whole model during the last growth spurt was agile, asset light. We're not going to own assets. We're just going to invest in miners, and that let us grow from being a very small miner to being the biggest in the world. Now it's all about vertically integrating so that we can do two things. One is get access to more capacity because a lot of the third-party hosted sites where we had miners running had additional clients and additional capacity. So by buying those sites, we're able to not just lower our own operating costs significantly, taking out the profit margin the third party was earning, as well as being able to operate the site more optimized to our specific needs and our preferences. But it also gives us access to additional capacity. And as an industry, we're constantly limited by one or more of the 3 C's, as I call it. It's either capital, it's either capacity, or it's compute, meaning access to rigs. And so right now, there's been a gluttony of rigs. A lot of the big miners like ourselves have placed orders and have options for gobs of capacity. Capital has been easier to raise now since Bitcoin has returned through the end of last year. And so every big miner that has a lot of capital, and the challenge has been capacity. So we have gone from in December owning less than 3% of the capacity where we operate. We're now at 53% owned and operated. And we'll continue to vertically integrate as well as add more capacity here very aggressively over the next year to 2 years. We believe that vertical integration also goes beyond just owning and operating sites. Technologically, we've built a full tech stack from the pool all the way down towards the ASIC. And now we just launched our immersion cooling systems at the Empower conference in Houston this week. Was a great success, a lot of interest in our 2-phase immersion because you're able to take miners that you otherwise could only overclock maybe 10, 15, 20%. You can now overclock them significantly over 50%, which means that the CapEx investment in your miners doesn't have to be as large to generate the same amount of hash rate. And especially with the energy efficiencies we're seeing in the 2-phase immersion, we believe that that's going to be have a major impact longer term in that you can invest less in miners and grow your hash rate even more. But also for Marathon specifically, it'll have an impact in that we're now offering this technology for sale to our colleagues in the industry, and we're seeing some very good interest for it. And we think that'll be a new revenue line, which will add, again, to the bottom line, more diversification between the firmware we're now actively selling, the immersion technology we're selling, and other technology products that will come to market over the next 2 years. You're going to start seeing Marathon's revenue streams be a little bit more diversified around traditional mining, what we call utility scale mining, around more energy harvesting, which are some of the projects we've talked about related to combining agriculture, methane gas capture with mining, and then our technology division as well. So it'll become more of a diversified business, but also a much more resilient business to ups and downs, and much less dependent on the foibles of the price of Bitcoin.
Yeah, excellent. But speaking about the miners, and you had mentioned that you have miners on order. For investors that are less familiar with the story, I guess could you talk a little bit about your mining portfolio, your outlook for exahash growth, and long-term targets, and perhaps some of the performance metrics that you look at when you're analyzing your mining portfolio, right? Is it, call it joules per terahash, Bitcoin per exahash, or a whole combination of them? I'm sure you look at everything, but what should, like, if investors were just to track a few key metrics, what would you recommend them to follow?
Great question. So if you think of our portfolio, we have the benefit that because our mining fleet is fairly young, we've been able to invest in some of the latest and most energy efficient miners out there. So our fleet's energy efficiency at stock, which basically means take the miner out of a box, plug it in, and operate it at its normal performance level, is about 24 joules per terahash, or 24 watts per terahash, where the industry average is somewhere between 30 and 33. So it means it takes less energy for us to produce the same amount of compute, which means given a 1 megawatt box, if you would, that we can fill with miners, I can, because my miners are more energy efficient, I can put more miners in that same box and generate more hash rate for the same amount of energy, which means I have more Bitcoin per megawatt of energy that I put in. The primary metric that we use for tracking is obviously uptime, hash rate hours, which are how many hours was our fleet hashing at what rate. And then we look at the cost to mine Bitcoin. What is our cost to produce a Bitcoin from a marginal cost perspective? So this is a little bit difficult in comparing miners because some miners only talk about their energy costs. They don't break out the actual operating cost of their sites separately. They bake all that into SG&A. And so it can be hard to really see what is the marginal cost for a miner to operate a site. What is the cost of the energy? What is the cost of the people, the staff there, spare parts, etc. We look at that marginal cost of each site on a per Bitcoin basis, which allows us to track it, and then we kind of show that number in aggregate for the company through our reporting mechanisms. But you really have to look at how much hash rate you have running, what your average hash rate was for the month. I think that's a good number for the investment public to look at, which really is an indicator of how much capacity you had that actually was running and producing Bitcoin over the course of the month. And then you can look at how many Bitcoin the company produced, divide that by their hash rate, and you can see what the efficiency of their hash rate is. Meaning, are they getting are they getting the right amount of Bitcoin that they should be for the amount of hash rate that they have online? And then the last metric I think that's very important for people to look at is the SG&A overlay. While most people just look at the cost to mine as a marginal cost, if you look at the all-in cost to mine a Bitcoin, from a cash perspective, you have to include the SG&A burden, which is, think of the executives, et cetera, burden across the mining fleet that the company has. And this is an area where Marathon is by far a leader. We have one of the lowest SG&As per exahash of capacity, if you would, of anybody in the industry. And we're a very lean team. And by continuing to grow and scale like we are, it makes us one of the most efficient operators.
Yeah, very good. So we're asking everybody about hodling, right? We're getting a lot of interesting answers. Just interested on your viewpoint on the thought process behind hodling, not hodling, and what you think is the right long-term strategy for the coins that you harvest.
Yeah, I think this is a very individual question on a
I
miner
think
by
so.
miner basis, right? Because again, if you think about capital being a constraint for some miners, then they have to sell every Bitcoin they produce to cover their cost to operate, as well as their to have cash to buy more miners and more capacity if they're growing. In the case of Marathon, we've had the good fortune of having access to capital markets. So we've been tapping capital markets for our growth capital. We sell Bitcoin on a month-to-month basis to cover our operating expenses. And then we're constantly weighing, are we going to use Bitcoin to pay for growth? Are we going to use equity? Are we going to use debt? What are we going to do? And we have the luxury of having $1 billion of Bitcoin in our hodl, which with the price appreciation in Bitcoin over the past year has had a significant positive impact, obviously, on our balance sheet. And then we also have a lot of cash and the ability to tap the capital markets. So we view really the average weighted cost of capital, and we say, okay, is it better for us to spend Bitcoin, or will it appreciate more than using equity and the resulting dilution, and looking at the accretion of whatever growth investment we're making? Is that going to be better using equity than using Bitcoin, and vice versa? And so with the increase in the price of Bitcoin and the fact that our cost structure doesn't increase at that same rate, we have been selling fewer and fewer Bitcoin in actual Bitcoin terms to cover our operating expenses. Meanwhile, our production numbers, produce a lot more Bitcoin than we have to sell. And so we continue to grow our hodl. And, today I think we're approaching close to 17,000 Bitcoin in our hodl, and, moving towards 20,000, which puts us amongst one of the largest hodlers out there. So we're firmly committed to continuing to hodl from a long-term perspective. Again, if the appreciation, the price of Bitcoin goes the opposite direction, then we may potentially sell more of the position. It really depends. It becomes a treasury management question more than an operating question.
Yeah, very good. Well, Fred, thank you. Your responses are always very thoughtful and beneficial. I hope that this was as interesting for our audience as it was for me. And thanks very much for carving out the time to spend with us today.
Thank you.